Imagine waking up to a new financial reality that could reshake your retirement entirely. The One Big Beautiful Bill, a monumental piece of legislation that sparked fierce political debate and passed with partisan fervor, is already altering the landscape for retirees, especially those in the legal profession. With its $3.4 trillion price tag and complex funding mechanisms, this law introduces sweeping changes to tax rules, deductions, and retirement strategies. But here's where it gets controversial. While some provisions offer clear benefits, others remain shrouded in ambiguity, leaving even seasoned financial planners to scratch their heads. Let's break down what this means for you, the retiring attorney, and why you should care deeply about these shifts. As a certified financial planner with years of experience guiding legal professionals through financial transitions, I've seen firsthand how legislative changes can upend long-held strategies. This bill is no exception. While the Treasury Department finalizes implementation details, we're already seeing opportunities and potential pitfalls that demand your attention. Let's explore the 5 most critical changes and why they could redefine your retirement plan. A game-changing deduction for retirees over 65. Starting with your 2025 tax returns, a new Senior Bonus Deduction offers an extra $6,000 in tax relief for individuals age 65 and older, $12,000 for couples. This isn't just a minor tweak, it's a seismic shift. For context, consider this. If you're a married couple filing jointly and claiming the standard deduction, your total allowable deduction in 2025 could soar to $46,700. That's the sum of the base standard deduction, $31,500, the existing age 65 plus boost, $3,200, and the brand new senior bonus, $12,000. But here's the catch. This deduction phases out if your income exceeds $75,000 single or $150,000 married. By $175,000 or $250,000, it vanishes entirely. For high-earning retirees managing partnership distributions or investment income, this creates a strategic window to optimize tax efficiency. And this is the part most people miss. The ability to stack these deductions without itemizing could be a goldmine for those who haven't traditionally itemized. Social Security gets a tax break you might not expect. Here's a twist. While Social Security benefits remain technically taxable, the new deduction structures mean 88% of retirees will pay zero federal tax on their benefits in 2025, up from 64% previously. The magic? Your deductions now outpace your taxable income, effectively nullifying the tax hit. But let's pause for a moment. The formula for taxing Social Security hasn't changed in over 40 years, and inflation hasn't been factored into the income thresholds. Does that mean the government is quietly taxing retirees on phantom income? The bill doesn't address this, but it raises a critical question. Is it fair to tax benefits based on outdated metrics? Share your thoughts in the comments. We'd love to hear your take. Tax brackets, locked in for the long haul. Remember the 2017 Tax Cuts and Jobs Act. Those favorable tax brackets, which were set to expire in 2025, are now permanent. This gives you a rare gift. Certainty. For example, if you were planning to convert a traditional IRA to a Roth in 2026, you'd previously risk a jump from the 24% to 32% tax bracket. Now the lower rates are here to stay. This stability is invaluable when timing Roth conversions or managing retirement withdrawals. But here's where it gets tricky. The bill doesn't rule out future changes to Roth IRAs, including potential required minimum distributions for large balances. Are you prepared for a world where even Roth accounts could face tax changes? Let's discuss. A lifeline for retirees in high-tax states. If you're calling New York, California, or New Jersey home in retirement, the temporary boost in the state and local tax SALT deduction cap from $10,000 to $40,000 through 2029 could ease your federal tax burden. This applies if your income stays under $500,000 annually. But here's the rub. The phase-out begins at $500,000, and the cap reverts to $10,000 in 2030 unless Congress acts. For lawyers who've spent decades in expensive metro areas, this could mean significant savings, especially if you're itemizing due to high property taxes. But will this temporary relief become permanent? Or will it fade like the last one? The answer matters, and it's up to lawmakers to decide. Estate planning gets a major boost starting in 2026. The Unified Estate and Gift Tax exemption jumps to $15 million per individual, $30 million for couples. For lawyers with substantial wealth, this creates more flexibility in transferring assets. However, this change primarily benefits higher net worth retirees. Will it last? The bill doesn't say, but it's a reminder that estate planning must adapt to shifting laws. And this is the part most people miss. Even if your estate is below the new threshold now, market gains or property appreciation could push it over in the future. Are you prepared for that scenario? What's next for retirees? These changes open new doors for tax-efficient planning, but they also demand vigilance. The temporary nature of some provisions means you'll need to act strategically while they're available. For example, the SALT deduction relief and Roth IRA uncertainty both require proactive decisions. And let's not forget the potential future changes to required minimum distributions, something that could upend long-term tax-free growth strategies. Are you ready to rethink your approach, or will you stick with the status quo? The choice is yours, but the clock is ticking. As you navigate this new landscape, remember, effective retirement planning isn't about minimizing taxes in one year. It's about building a flexible, sustainable strategy that adapts to legislative shifts and your evolving needs. These provisions give you tools to do just that. But here's a final thought. How will you leverage these changes to secure your financial future? Share your perspective in the comments below, and let's keep the conversation going. Disclosure. The information provided is for educational purposes only and should not be construed as tax, legal, or investment advice. Always consult a qualified professional before making financial decisions.